Hopefully, you know by now that we don't like to make prognostications. We know the one thing that's for sure is that the prognostication will not be right. So please take anything we say with a grain of salt. Having said that, we do analyze a bunch of data, and we want to share some of that data with you and walk you through where we think things are. So I will go through the slides quickly, but try and talk slowly. So we say this is the most important slide. We've actually broken it up into 2 slides this year. It's the mean reversion slide. What we're looking at is that single family house prices in the GTA have gone up by 7% a year going back to the 60s. And so we look at home prices relative to that gray average growth rate line, just to use it as an acid test to see if prices are reasonable. And you can see we were tracking in in 2017, prices were significantly above. They were 28% above the mean line. And at the time, if you recall, we were starting to take our foot off the gas, which helped us manage through that period where eventually prices came back down. And this time around, you can see the prices peaked at around 55% above the mean line, which is significantly high. And we didn't know how high they would go, but we knew it was a problem. Since then, prices have peaked and they've come down. And if we zoom in, so this is just looking at that same chart, but just zoomed in from 2016 to now, you can see that prices peaked at 51% above the mean. Then they started coming down. And so this is actually fairly healthy because you can see that we're now only 9% above the mean line. And our portfolio has done quite well because we started taking our foot off the gas before we hit the peak of 51%. And so we just use this as a test just to measure risk in the collateral that we're lending against, which is a lot of it is housing. The good news is that we don't have significant price declines required to get back to the mean line. And it doesn't mean that we hit the mean line. Prices could go down such that you're below the mean line. But I think it does mean that any loan originated today certainly has a little more buffer, a little more margin of safety than something that would have been originated at market peak. We also wanted to try and analyze if there was a different way of thinking about how much downside could be left in housing prices. And so what we did was we said at the market peak, it would have cost $1,335,000 to buy a home. And we created our own benchmark for mortgages based on a split between 5-year variable and fixed because about a third of the population is variable. So we created a custom mortgage benchmark, and it said that it would cost $4,500 a month to carry that mortgage if you bought the house at peak. We then wanted to look at, given the change in interest rates, what would house prices need to drop to so that the monthly payment would still be $4,500 a month? And the answer is they would need to fall from $1,335,000 to $971,000, which is a total drop of around 30%. They've already fallen 19%. And so if you believe this model, you've got about another 10% downside in housing prices. Obviously, this is not going to be accurate. We're just doing this to see, as long as we can be directionally correct in our analysis, we can kind of assume that maybe there's another 10 to 20% downside remaining in single family houses. But that's why you've seen us running with a 55% loan to value in our Foremost Mortgage Trust. Okay, so what we usually like to do is we look at the drivers of pricing, generally being supply and demand. And we're breaking it up this year by looking at the stuff that would be helpful to house prices, and then we'll look at the stuff that would hurt house prices. But on the bullish side, you've got housing starts, which are driven by a bunch of things, including zoning laws and land use policy, and now construction costs. And all of those have been constraining on supply, which is bullish for house prices. And then it's just the availability of inventory for sale, which we'll look at. And then on the demand side, you've got employment, immigration, and household formation. So if we take a dive into it, this chart's pretty busy, but all you really need to look at is the red line sloping downward, which is housing starts. It's a trend for housing starts. And we're actually creating fewer houses today than we were 20 years ago. But in that same time, look at the green line, it's population. Our population is growing significantly, and we believe that that is actually going to accelerate even more. So you've got declining supply, and increasing demand driven by population growth, which is very bullish for house prices. Now, given that, even in the short term, what we have to look at is over here, you can see that sales volumes have declined significantly, which is what you would expect given how unaffordable houses were and then the interest rate increases. So prices have started coming down, which you can see in the first green box in the middle. Just an interesting sidebar, Toronto and York region are down much less than Durham, Halton, and Peel as examples. And more than half of our portfolio is actually in Toronto and York, which buffered us a little bit. But the most important thing on this slide when we talk about availability of inventories, if you look for 2022, you still have less than normal inventory, anywhere between 1.8 and 2.6 months of inventory, which is still below normal. So the availability of stuff for sale is still tight, which could help underpin prices. Employment is a little bit of a mixed bag. We've had strong employment. You can see that after COVID, we generally jumped back up on trend with where employment should be. So you could argue that employment is still strong and bullish for house prices, although it is a bit of a warning sign that it's ticked down quite a bit just in the last quarter. So it's something to keep an eye on, which we'll talk about a little bit more when we talk about recession or no recession. This is a big one, population growth. So you can just see the trend. If you look at the orange bars, just look at the change in the magnitude. Population growth has picked up significantly. And, you know, our thesis is that in order to service all of the debt that the government has incurred, one way to grow your tax base is via immigration. And they've already announced that they're going to be leaning heavily on immigration. We don't think that's going to change, and that's very bullish for real estate. Just a thing on immigration, this is quite interesting. So the light blue bars shows the distribution of the population, and then the dark blue line shows the distribution of the immigrants. And you can see that most of the immigrants are working age, which are very positive economic contributors. On the supply side, construction costs have exploded, and land was obviously more expensive, and now interest rates are so much higher, so it's much more expensive to carry land. So we're seeing a decline in demand from our borrowers, which I think you could probably extrapolate across the economy, which really means that you're probably going to have a 1 to 2 year slowdown in the production of housing supply, which will be very bullish coming out of that, obviously, because there's going to be an undersupply that's exacerbated by what's happening right now. Okay, so now quickly looking at the bearish drivers, which basically on the supply and demand side, we think are the same. It's interest rates and just balance sheet strength, how much leverage there is in the system. So on interest rates, this chart's got a lot happening. It's quite interesting. If you look at the red line is the pace, it's basically the pace of interest rate increases. So it's how high the Fed increases rates after their first rate increase and how long it takes for them to increase rates. And except for the dark gray line, which we'll talk about, most interest rate increases have been a little more measured and over a longer period of time and not as extreme. And so that's something, is that the current cycle has been it's been extreme in how quickly rates have increased, and we haven't seen the full effect of that because it takes anywhere between 6 months to a year and a half to fully feel the impact of interest rate increases. We weren't showing originally the late 70s and early 80s interest rate regime, which made the red line look that much steeper. But then we decided just to have a look what happened, because maybe history can be some sort of guide. And what was interesting, at least to me, is that you can see that this story has been played through before, where they increased rates. In the early 80s, what happened was they actually caused a double dip recession. So they caused a recession, then they quickly became reflationary and dropped rates, which caused even more inflation. And then they got to the Volcker, you know, what everybody talks about in the Volcker era, the super high, you know, 20+% interest rates. And so Policymakers are obviously aware of that, and so it'll be interesting to see how they navigate, especially what's happening now, where they're starting to see some more signs of inflation not moderating as quickly as they thought. Anyway, bottom line, interest rates have gone up. They've gone up significantly, and they've gone up quickly. We have no idea where they're going to go from here, but it certainly changes the calculus for any buyers of real estate. Another big measure that we like to look at is liquidity, because at the end of the day, availability of money will determine how many people have that money to chase assets. And it can be any asset. It can be speculative stuff like cryptocurrencies, and it can be real estate, and it can be stocks. So these are just proxies. You don't necessarily need to spend too much time squinting at what you're looking at. You can just look at all the downward facing red arrows. The Fed's balance sheet is contracting. That's called quantitative tightening. They're reducing liquidity in the system. The monetary base is declining. We like to look at the reserves of depository institutions, because if banks have access to capital, they lend that money out, and that multiplies through the economy. Right now, that's contracting. And then just looking at Bank of Canada, their assets, their balance sheet's actually contracting faster than the Fed's is. So liquidity has been sucked out of the system. And there's another measure here which just looks at, it's kind of a composite metric for overall liquidity. And you can see that it's been on the decline for at least a year and a bit. And that will ultimately be reflected in asset prices as well. Talking about balance sheet strength, we're pretty highly leveraged, our households. Now you can see before the great financial crisis, Canadian household balance sheets were less leveraged than Americans. We were, let's say, a little more conservative. But we didn't really suffer significant pain the way America did in the 08-09 crisis. And you can see that there was a forced deleveraging that happened in the US. But in Canada, we kind of, we stabilized and then started increasing leverage again. So this just, the reason you need to look at this is because it just means that we're less resilient in Canada to significant increases in interest rates, which is, I think, why you saw the Bank of Canada slowed down before they pivoted, before anybody else, or at least announced that they were thinking about pivoting. Whereas in the US, it looks like the Fed might have to keep increasing rates more. So it'll be interesting to see how that plays out. But you have to pay attention to what we're calling the debt trap, which is too much leverage in the system in Canada. Okay, so we're almost at the end. We like to go back and look at all of the experts and what they predicted, just to prove the point about how ridiculous it is that we want to rely on predictions, but we all want to rely on predictions. Everybody in 2022, except for CIBC, predicted that prices would go up, and in reality, they went down. So very few people got it right in 2022. I guess you can say congratulations to Ben Tal and the team at CIBC. And then if we look at 2023, these are the predictions now. Everybody, it's called recency bias. You look at our most recent experience, now everybody's predicting the prices will go down. So probably a reasonable prediction. We don't know. All we know is, what we've modeled, which is that it wouldn't be unreasonable to expect another 10 to 20% decline. So, and CIBC, if you believe they're the most accurate, just because they had 1 year of success, they say 10 to 15% down. So those were their predictions. I like to keep us honest and go back and see what we'd said. So what we said in June, which was at our AGM, we said that in the short term, rates would continue increasing, which they did. We said, could there be a Fed-led recession? Well, we haven't seen it yet, but I would leave that up there, which you'll see in a second for our kind of what we're saying now. We said that prices have peaked. Will they move down or sideways? Well, they moved down. Now they look like they're maybe moving sideways, but it's a bit early to tell. But then we said there's a lack of supply, which may set a floor on prices. And so what we did not see is kind of a 50% decline in real estate prices, which would have been catastrophic. You've seen a more measured decline, which is healthy. It's healthy for the market, and it's better for us as lenders. What we'd said is in the medium term, again, Fed-led recession. We talked about the debt trap and that actually requiring interest rates to go down. We said there could be strong immigration. prices moving sideways, and you always have to make allowance for a black swan event, which is some unexpected thing. And then we're always bullish long-term because of the supply-demand mismatch. So what are we saying now? In the short term, we're saying, the mean reversion is happening. We believe that needs to continue happening either via more downside in house prices or sideways movement in house prices, which allows the mean line a chance to catch up. Interest rates, we're that little icon guy with his hands up in the air. Who knows? I mean, we know for sure we're not going to get the call right. All we can do is acknowledge that we're not going to get the call right, look at the world and say, at large, it seems like there's more risk out there, so we take our foot off the gas. Although we are starting to feel like there will come an opportunity fairly soon, as you've heard from Neil, on the equity side as an example, where it'll come time to put your foot on the gas once you start to bounce around the mean line. We still believe there could or should be a recession, so we're leaving that up for the short term, and home price declines continuing. Medium term, arguing more for this muddle through type economy, which is not amazingly good, but maybe not terrible either. Again, watch out for the debt trap because we're very sensitive to interest rate increases. Black swan event, something bad will happen. We don't know what it is. And when it happens, we'll all look on it and say, wow, I mean, that was so obvious, but it's not obvious to us now. And immigration is already ramping up. And long-term, we still remain very bullish for the reasons we identified, mostly being population growth and not enough supply being created. So that, I think, is where we're going to leave things.